Right, so in this video, I'll be doing IFRS 15. Now, before I do this, I'm going to put a lot of my own examples, a lot of my own information, and tell you this instead of reading the notes too much. Because in doing this, it's just too complicated the way it's written over here, so it's very, very hard to understand. But, I'm going to make it very, very simplified. Right, so let's get to it. Now, what is IFRS 15? Now, IFRS 15 deals with the revenue recognition. Now, you might ask, what is revenue recognition? It's sales, right? Revenue is sales. So, when do you record sales in a business? Now, you might ask, why? If you just sell something, you're going to get the money, so just put sales. But that's not the case, right? Now, revenue is an income arising in the course of activities, right? So, the way revenue or income is defined is basically increases in economic benefits during an economic period, form of inflows or enhancements. So, inflows are like money, money coming in the bank account, all that. Enhancement of assets or decrease of liabilities. It's the same thing, enhancement of assets. So, your bank increases, that's an enhancement of asset. That results in increase in equity. Remember, assets equals to owner's equity plus liabilities, right? So when you receive 500, for example, in your bank, you'll say debit bank, and then credit whatever income was that, right? If example sales, and income does fall under equity. Just to revise, what accounts are fall under equity? It's the acronym ICED. Okay, ICED, ice cold iced. So income, capital, expenses, and drawings. Those are equity. And other those relating to contribution for equity part. Okay, so basically not to the owners. So if a owner has an expense or an income, it doesn't go into income in the business. It won't go in the financial statements. Now a contract. Now people get a lot of confused with IFRS 15. But this whole contract thing, what is it? A contract is not a paper. People think now every time they picture contract is a piece of paper. Yes, it is. But this contract is not a piece of paper. Well, it is a piece, it can be a paper. But I'm saying mainly what people focus on is a piece of paper. A contract is a promise. A contract is telling a person that I will do something and you do it. For example, contracts don't have to be acknowledged. If you go to school or if you pay your school fees, the contract is that you will attend all the classes, that you will write the exams. That's a contract. If you go to a shop and buy something and you pay for the good, that was a contract. You took the good, you're supposed to pay. That's a contract, it's a promise. If you literally, let's say, um, I don't know, went to a hospital and there was all patients all around you, and you have to pay the hospital bill. That's a contract. So, a contract is a promise. It's an agreement between two or more people, and I think an agreement between two or more people is a good definition of contract. So remember, a contract, when you think about it, don't think of a piece of paper that people have to sign. No, it's like an agreement, okay? That creates enforceable, so obviously it needs to be enforced. Now, customers are defined as a party that has contracted with an entity. So, customers are basically people who get goods or products or services from businesses. That is a simple way of understanding this, right? Output of entities ordering activities. So the output of businesses are like their products, what they sell or what they offer, and so on. Now, going further, what is the objective of IFRS 15? So it's to establish the principles that an entity shall apply to report useful information for financial statements and all this stuff, right? So basically, what's this whole thing about IFRS 15? Now, IFRS 15 stands for International Financial Reporting Standards. So basically, what needs to go in a financial statement has to be important. There's rules. You can't put anything in the financial statement. That is why revenue, there's specific rules under IFRS 15 that allows you to put the revenue you got or do not. Sometimes you may think you got a sale or you might get revenue, but that sale you can't put in a financial statement. And these are the laws that will tell you what can you put as sales in a financial statement, what can't you put as sales in a financial statement. Now, IFRS 15 is actually quite new. It's only been here from 2016. So before all this, there wasn't IFRS 15, right? It was all like split up into different parts, different financials, different rules, and so on. Now, IFRS 15 is only related to contract with customers. I repeat, with customers. So don't get confused. Leases, insurance, all that, no. This IFRS 15 is you as a business and customers only. That's all. And also, it's not with businesses. So if you buy from another business or whatever, they're the customers, that's not allowed, right? You're only dealing with you as a business and the customer. That's IFRS. So recognition, so an entity recognizes revenue to depict the transfer of promised goods and services to customers. Yeah. So obviously revenue is recognized because at the end of the day, that person paid for something which you promised them and they got it. For example, you buy a good, you buy a product, they promised you, listen, if you give me this amount of money, I will give you that product. So this whole promise is the contract. So this whole IFRS thing, right? There's 5 steps, right? Step 1 is to identify the contracts with the customer. So what this means? Identify the promise. What is the promise, right? So the promise may be, I'm going to build a house for this person. So let's say you're a building company, right? Construction. So let's make this whole thing a business here. So all these steps, I can tell you that how it works. Eh? So let's say we're a construction company and we're building a house. Identify the contract with the customer. It's the house, right? The house we need to build. We need to know who is the owner. Who are we interacting with, right? We need to know the name, the people, and so on. We need to know what are the people have to agree with us, right? In the contract, in the promise, we have to like make them sign, make them acknowledge all that. All the prices needs to be there, and so on. Identify the performance obligations. PO, which is performance obligations. What is it? Performance obligations is what you as a business need to fulfill. It's your promises. So your promises are what you need to do as your part to the customer. Remember, you got your business and you got your customer. The business made a promise to the customer for something. That's your performance obligation. Me as the construction company, I told you I'm building a house. What is my performance obligation? It's the house, right? It's to actually build the house. Step 3, determine the transaction price. Now, you need to understand what is this transaction price. So obviously the business and the customer, when you promise something, you're going to promise him something when he gives you that money. So you need to know, like, okay, what is this price of this particular thing? You need to get a price, right? Also, revenue, the amount you record revenue depends on the transaction price, right? Allocation of transaction price to performance obligation in the contract. This is very important. So me, I'm building a house, right? There's a lot of questions you may ask, right? So let's say if I'm building a house for 2 years, and this whole house, I got paid 2 million rand to build it for 2 years. Now, how will I record the sale? Will I say I got a sale of 2 million rand this year? No, I would split it into two. The first year, I got a million rand in sale, and the next year, I got a million rand in sale. Because that's how you allocate the transaction price of the whole thing, the whole house, to those both years. Because it took you 2 years to build the house, right? And step 5 is to finally recognize the revenue for when the entity satisfies the performance obligation, right? So when you do whatever you promised, you record it in your books. That's the easiest, right? Now, remember COPA, that's how they do the acronyms, right? COPA. But to be honest with you, I don't even like recognize the acronym your COPA. I just like, you can just like picture it what happens, right? Because these are like, these three over here are literally the same. So yeah. So this is so the PowerPoints give you a definition of what all this is. You can pause and read this. Uh okay, so IFRS 15. Now we go on to step 1 to identify the contract. So I told you it's agreement between two or more parties. It can be written, oral, verbal, implied. So implied, it's like you know it's there. For example, if you walk into a shop, it's implied that you must, if you're going to take a good or a product outside your business, you must pay. That's implied. Verbal, you talk, right? So you tell a person, if you go and if you I don't know, if you milk the cow, I'm gonna give you 100 rand. That's a verbal. Written, if I give you a piece of paper and I tell you, if you sign this, right, I will give you a product, you give me 100 rand. And if this is like, for example, online a written agreement is very very easy, right? Okay, so all contracts must have five attributes. Another word for attribute is a description. So what we must have, the qualities. Two parties must approve it, right? I have person A, person B. They both must say yes to the contract. One person can't say no, otherwise the contract is void. Can't happen. Each party's rights must be clearly stated. Each of those two people, a business and a customer, have to be stated, right? What are their rights? Payment terms. So if you're a debtor, if the customer owes you money, you have to tell them when they need to pay that money. Commercial substance is very important. The contract which you're making has to be something that is important. Don't make a contract that doesn't affect anything. Commercial substance means when you make that contract, you're making that contract because it'll influence your business, right? It has commercial substance. So for example, let's say if you're going to, you're making the contract because making the contract is going to be very very important. Don't make it for a stupid reason, right? That's commercial substance. Probable recollection of consideration. Okay, so do not record a sale which you know you're not going to get the money. For example, if a homeless person comes to you and says he wants to buy a Lamborghini, will you record that as a sale? No, he probably won't even give you that money, right? He's trying to rob you, yeah. So if you don't think you can get that sale, that revenue, you don't record it. And this is where you know how bad debts and all that comes in, where you know you're not going to collect that revenue, right? Actually, yeah, just now we're going to use discounts, settlement discounts, to actually illustrate it. So step one, combination of contracts. Now you might be thinking, what is combination of contracts? Yeah, combination of contracts are like combination of promises, right? They either can be combined or separate. Now, what you must have for it to be a combined contract? Single commercial objective, right? Price or performance, single performance obligation. Okay, so now all this might be thinking what it means. If I'm building a house, right? I need cement. I need, what's it called? Blocks. No, bricks. I need bricks. I need cement. I need paint. I need all that to build a house, a finished product of a house. But will I say that my obligation is to put the bricks? My second obligation is to put the paint. Third obligation is to put the cement. Fourth obligation, I literally have 1,000,000,000 obligations, man. IFRS says no, you do not have all these obligations. Because the house is one, the finished product on the contract is you want to build a house for that person. It's one obligation. The house is a one obligation. A construction company going and building a hospital, what will be that? It'll be two contracts or one or many. It'll be one contract. You're building a hospital. If you are a cell phone company and you buy a cell phone, but also you buy insurance, is it one or two contracts? Now that is two. Why? They're two separate things. A cell phone and insurance for the cell phone is two separate things. They're not working together. They're not interrelated with each other, right? They're two promises. You can go to a cell phone shop and buy insurance separately. You don't have to buy the cell phone. You can buy the cell phone and not have insurance. They are dependent, right? Dependent. Now, so obviously these are all the things that make combination or so modification, basically changing the contract. So obviously you might change the contract when there's adjustments, okay, when termination of contracts or a person just dies, right? So you need to change the contract, so these allow for changing the contract, right? Okay, so this is a very good example. So example one, so a real estate developer, if you don't know what's a real estate developer, don't worry, just think of a person selling a house. Simple. So a person sells a house, enters a contract with a customer to buy this house for R1 million. The customer wants to open a restaurant in this building, right? The completion of the restaurant is very high. The customer pays 50,000 deposit and take the loan for the buyer would be repaid, including interest using proceeds from the restaurant. I'm going to summarize this. This person is selling a building, and then this customer wants to buy it for R1 million because he wants to operate the restaurant. He doesn't have any money, so he wants to go borrow money from the bank, or he wants to borrow money, a loan, and he's going to give us that money back. Obviously we are offering that loan to that person, right? And yeah, so that's it. And obviously every time you buy a house you need a deposit. So now let's see the solution over here, right? So this is very important, right? He doesn't have the money. So if he doesn't have the money and getting a loan, isn't that looks bad? Also, there's something missing in the PowerPoints here. They actually added in the notes, if you look at it, he has no assets. This is supposed to be it has no assets, but he got left out. So that says that, listen here, if he has no assets, right, and if he's taking a loan, he probably won't even repay back the loan. So technically, that sale of which you're going to get 1 million, you might not even get that money. So to think about this whole situation example clearly, you are a person and you have a friend. Your friend tells you he's going to give you R1 million, right? For, let's say, your house. So you tell him, listen, you're okay, it's fine. I'll sell it to you R1 million. He'll say, okay, I'm going to take a loan, R1 million from you, and I'll buy the house from you R1 million. Or he got a loan from somebody else and give you that R1 million. You know your friend is a total liar. He's not going to give you the R1 million. You won't record it as a sale. Why? Because you probably won't get the money. So it's not probable that you will get this money, right? So if you look at the answer, a contract fails on the probability of collectability. So I told you, you're not going to collect that money. The amount would issue the loan's point of view, right? So I told you, he probably won't even get the money. I mean, pay us the money, because the loan he probably won't even pay the loan. He won't even probably get the loan, to be honest, to start off with. And also the 50,000 rand. Anytime you get this, right? So let's say a customer gives you a deposit for something. Any business, if you get a deposit, it's a liability, right? You'll say debit, bank, credit, deposit, liability. Or actually we say income received in advance instead of deposit, right? Because that's actually money given in advance. But like, you can reverse this when he actually like buys a house or whatever. Okay, so we're on step 2. Identify the performance obligation. Identify what you need to fulfill. You're a business, identify what you need to give to the customer. So a promise is a contract with a customer to transfer distinct goods or series of distinct goods. Now, distinct goods and services are not combined, right? Distinct means different goods and services. So a good or service could be a bundle, it could be distinct. Now, a series of distinct goods and services that are the same and that have same patterns, monthly service, accounting services. Let me just see. Okay, so a series of distinct goods or services have the same pattern to transfer to customer. The following are met. Let me just read certified over time. Okay, so basically, so you'll understand it, right? So distinct goods and not distinct goods are like combinations and not combinations. For example, if I tell you I'm building a house, it's going to be all together, so it's not going to be distinct. Your contracts won't be different, right? You're building one house, that's one obligation, one contract, right? So basically that is distinct and not distinct. So we're still on step 2. Now, contracts can be explicit or implicit. Explicit, it means it's written clearly down. So when you get a contract, it's literally right in front of you, your rights or whatever. Implicit, it's like policies or rules. For example, if you go to a shop and if you get a product, it's implicit that you're going to pay for it, right? It's like you have to pay. You know that you have to pay. Explicit might be something that's clearly stated. If you want to buy a car, they'll tell you each month how much you have to pay for that car. They'll literally write it down on a page for you to sign. That's explicit. Um, a promise is not separately identifiable. So, so a promise is not separately identifiable if the entity uses as an input to produce other delivered goods and combine as a highly dependent on highly creates. Okay, so a promise is not separately identifiable. What does it mean, not separately identifiable? English of it. I know why they're using so big English words. Not separately identifiable means it's the same, right? A promise is not. See, the English is hard, yeah. Not separately identifiable. Oh yeah, it means it's the same. If it's not separately identifiable, it's the same. So a good or service is the same to good. Wait, it's not highly but not highly considered. Um. So a promise is okay. Let's get. I don't not separately identifiable. I don't know why my brain's now just fried. I'm just so confused about what does it actually mean. Not separately identifiable. Wait. I know negation belongs in nuts. If let's say if it is separately identifiable, separately identifiable, not separately. Yeah, not separately identifiable means the same. Yeah. It means the same. Because separately identifiable means it's different. Not separately, that means it's the same. Oh, I get it. Right. Highly correlated, highly dependent. Okay, a house. Everything is correlated. The concrete, the bricks, the paint, everything is put together. So that is why the promise is one promise, right? It's not different promises. You get what I'm saying? When you want to build a house for someone, the paint, the rocks, all those are not they're not separate obligations, right? Yeah. Yo, it took me so long to figure that out. My brain that just fried right now because it's nighttime. Anyway, a good service is promised to customers distinct if both following criteria are met. If it is distinct, if both, see, it's not proper English here. If it's distinct, they should have a comma. If both of the following criteria are met, okay. So it's different if these are the following criteria, right? The goods or services are is capable of being distinct, right? The customer can benefit from the good or service on his own or together. I told you, right? If you have a cell phone company, you can buy insurance or you can buy a cell phone. So it can be distinct. It's capable of being distinct, different. Good service is distinct in the context of the contract. Um, so if you have a contract and it clearly states that it's different, then it's different, right? It's clearly stated. A promise is the same, and yeah. So I told you it's correlated. So if you're building a house, if you're building something, that's the promise. If you build a house, build a hospital, build an airport, it's one promise. Not everything that goes into building it are separate promises. No, it's only one promise. Distinct goods or services. So what is distinct? Okay, so let's read the example. Yeah, a contractor, a builder, enters a contract to build a hospital. The contractor is responsible for the project management as well as provision of various goods. So there's two things here: provision of the goods and project management and services. Oh, so it's a lot of things, yeah. Are each set of the goods and services separate obligations? I mean, you know the answer. I just told you. Are all of these separate just to build one hospital? No. Why? They are not distinct because it's a promise to transfer the individual goods or services together and therefore both are not met. The building of the entire hospital, the hospital is one obligation. So these are not separate obligations, right? So step 3, right? Transaction price. Transaction price is basically, I told you, how much are we recording the sale for, or how much is like the amount we're recording it for, right? So obviously it's the amount which you expect to get from the customer. It can vary, right? There's a lot of ways to consider what something is worth. Fair value, you do this in accounting. This video is accounting. Fair value is the amount which something is going for. Right now, if a car is going for 100,000, that'll be the fair value. Percentage financing component, yeah, bonuses. Okay, yeah. So it can be fair value. It can be based on market prices. It can be based on what you sell it for. It can be based on what if the customer has a voucher. That's it's easy, right? Refund and liability intake. Okay, so let's read this. And business enters into a contract with 100 customers that sells one product to a value of 100 rand per product. So 100 times 100 will give you 10,000. So 10,000 rand is the revenue. But right now we're going to check if we can put the whole amount as revenue. Cash received and control transfers. Very important. When you recognize revenue, they must you must control they must have control of whatever you're giving them, right? Or the promise. To allow return within 30 days for full cost of the product is 60 rand. Entity expressed at 97.1%. Simple, right? You are selling 10,000 rand worth of products, right? 97 of those products won't be returned. 3 of them will be returned, or most likely will be returned, right? 97 products, let's convert this to a number. 100 rand each product, that's 97,000. I mean, the 9,700. 100 rand each. Okay, so 9,700 rand worth of products won't be returned. That means the customer will use it. But 3 of these products will be returned. That means 3 products will be returned. So this customer will return 3 products. 97,000 products won't be returned. 3,000 will be returned. So what you're going to do here is a journal entry. Now, they don't tell you the journal entry over here, but I'll tell you. So the journal entry is very simple, right? A customer comes and buys this 100 products, right? The first thing you do is, okay, let's say you bought on credit. Debit trade receivables. Let's see. Can I write over here? Wait, let me just check something. Oh yeah, I can write actually. So debit trade receivables. Now I'm just gonna put trade receivables here. Debit trade receivables, the full amount, that's 10,000. And then what you're going to do is credit revenue. And then also you're going to credit something called, let's see, I'm just thinking what it's called, man. Come on. Okay, revenue is easy. If it's 97 products, if it's going to not return 97 products, that means he's going to keep the 97 products. That's 9,700. 100 on each product. And then, yeah, I'm just thinking what this the word is. I just did it now. It's a refund liability. Yeah, refund liability. Perfect. Refund liability. Now you might be thinking why. 300, right? 300, yeah, 300. Why? Why are you only recognizing 9,700 worth of revenue? This applies to 97 products. They're telling you over here this person is going to return the other 3 products. So why are you going to recognize the 3 products that he's going to return as revenue? Don't do that, because he's going to return the products. So that 3 products are going to come back to your business. So that won't be a sale. The only sale will be the 97 products which you won't return. So if he's not going to return this 97 products, then he's going to keep these products. This is your sale. If he's going to keep the products and not returning, that's your sale. But if he's going to return 3 products, that's not your sale. So right now we do it as a liability. Now, when he gives us this product, we do a reverse entry, right? We'll say debit this refund and then credit trade receivables, right, of 300. Okay, step 4, second last step. Allocation of the transaction price over individual performance obligation in the contract. So your promise is, if you're building a house, how do you allocate this price over a period? I told you 2 years you're building a house and the total price is 2 million. How do you allocate this? So it's simple, right? Simple. Allocate. Okay, so firstly, allocation on transaction prices standalone. What is standalone selling prices? It's what the product you are selling for is what it is. So it's allocation of transaction to each performance obligation. So when you do an example, so you'll actually see all this is too complicated English. Okay, so market assessment approach is basically you want to know what's the price. What is this transaction price of this product you got in your business? or what is this service, or basically whatever you're selling to your customer, what is it worth? You can see in the market what other business, your competitors, are selling it for. Cost plus margin, easy. If it costs you 100 rand to buy the good, you can sell it for 300 rand, make 200 profit. Residual approach, if you have two products, one is 100 rand, but you know the total is 500 of these two products. What the other product be? 500 minus 100 is 400. So it's like solve for X. If you have two products and you know it's at like 500 rand, if one product is 100 rand, you want to know what's the other product? Simple, right? Solve for X 400. So yeah, so let's do this examples. Very very good examples, right? Okay. So how do you allocate this transaction price? Now, again, this English is not good, but basically what they're saying over here is this, right? So this is the price of three products, right? Now I'm gonna tell you a very, very easy way. Think about this is a restaurant, right? This is a burger, this is chips, this is a cold drink. You can either buy those separately. So you can buy this burger for 50 rand separately. You can buy this cold drink for 25 rand separately. You can buy this chips for 75 rand separately. But they got a special. You can get a combination, a combo, all that for just the price of 150 rand. Actually, no, wait, hold on. 100 rand. You see, 100 rand. So the special, the discount or the price you're getting for is 100 rand. But you know all these put together, if you add it up, it's 150 rand, right? Is it 150? Yeah, 150 rand. But this is a combo. So I'm a real life example. This is how restaurants work. So now, if you want to record in your books how much each of these are worth, because look here, what's going to happen is this: a burger, a chips, and a Coke. Those are separate products. They are differentiable. You see, they are different. What you record in your books, whether it's a burger or chips or Coke, is all three are different products. They're not one product. Like a burger is one product, but these are all three different products. So you got 100 rand worth of sale on these three products. What you gonna put in your books? Sale of what? You're gonna put a sale of burger, sale of chips, sale of cold drink. But you can't do that. You can't put sale of all those three items. You have to put a sale of each item. So how do you know what's the price of each item? How do they get A of 33, B of 17, and C of 50? Very, very easy. Proportion. So to work out that, right, proportion, take 50 of A over the total 150. That's 1/3 actually, times 100, and you get 33. And if you work out what's 33 plus 17 plus 50, that's 100 rand. So you're basically splitting this 100 rand into the three products, right? But in the proportion which what it was. Because in your financial statement, your journal entries, you'll see debit bank, credit sales burger, debit bank, credit sales chips, debit bank, credit sales cold drink. Because these are three separate items which you're accounting for, right? You're not going to say debit bank, credit sales 100 rand, 100 rand, and just leave it. You need to know what was the sales for. Step 5, this is the last one. Recognize the revenue when an entity satisfies the performance obligation. Alright, so you only recognize revenue when you done the obligation. For example, if you're building a house for 2 years, if 1 year half the house is complete, you can recognize revenue for that year, half of the actual full price. Okay, so very very easy. When the customer consumes the benefit, you record the transaction. Okay, so all these you can record the transactions. One good example is an online business. You buy from an online business, Takealot. When does Takealot recognize the sale? When you buy the good? No. It's when you get it delivered. You see, when you got control of this good. Control, here's it, your control. When you consume its benefits. When you got the good on you and you have a right to use a good, then you recognize the revenue. And that's it for IFRS 15. Yo, this was like my longest video, I think. Yo, sure. That's insane.